how to rescue a poor performing whole life policy. In this episode, I'm going to clarify, first of all, what I mean by a poor performing whole life policy, because the first question you have to ask yourself is, why did you take out that whole life policy? If it was primarily for the death benefit and to make sure that death benefit stays in force under a worst case scenario with the guarantees, you probably don't need to rescue that whole life policy, okay? But get ready, because I'm going to show you the way that you rescue a poor performing whole life policy is basically the same way you rescue a poor performing indexed universal life. There are whole life proponents out there that talk about, oh, I can show you how to rescue an IUL, as if all IULs are designed poorly. No, not all whole life is designed poorly, not all IUL is, but I'll have to admit, most of them are designed poorly, especially if the goal is for living benefits. So get ready. I'm going to show you how to rescue a poor performing whole life policy, how you can, first of all, determine if it's poor performing and how you rescue it. But it's the same answer for a poor performing indexed universal life policy. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for over 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. Now, if you've watched very many of my 2,000 plus videos on this channel, you will learn really quick that my favorite financial vehicle for living benefits, to accumulate money at the best internal rate of return, tax-free, and create the highest net spendable income so you don't outlive your money, and then leave behind the most money when you die, is a properly structured max-funded IUL, okay? And so I'm here to tell you that, unfortunately, the vast majority of index universal life policies in America are not designed to perform what I'm talking about. And so it's very easy for these whole life proponents to say, oh, here, I can rescue your IUL. Well, yeah, because they can show that it's not designed to do what that client probably thought it was going to do. Well, the same formula that I use to rescue poor performing index universal life is the same formula I use to rescue poor performing whole life, okay? So let's talk about this and what it means. So first of all, if you own a whole life insurance policy, before you just assume that it's not the best vehicle, you have to ask yourself, why did you take out the whole life policy? If it was primarily for death benefit to create an immediate estate, which life insurance does if you happen to die, okay? If you were protecting yourself so that your heirs, those that you leave behind if you happen to have a premature death, that they would have a tax-free death benefit, whole life is okay, okay? It's not my preferred way to the most economical way, in my opinion, to buy death benefit. Nonetheless, it's okay. Whole life was designed primarily for a death benefit. It's designed that if you pay a certain amount of premium into the policy, there's guarantees in there that will make sure the death benefit stays in force to a certain age or whatever, okay? Because that's what it was designed for. Now, that's not why I take out max-funded insurance. I do it for the same reason that E.F. Hutton, who was the brainchild behind the emergence of universal life and then later index universal life, they came up with it for living benefits, okay? Because it's the only vehicle in the Internal Revenue Code that allows you to accumulate your money tax-free under Section 72E of the Internal Revenue Code. I'm talking about whole life and universal life, cash value life insurance. You can access that money income tax-free under Section 7702, okay? And you, when you ultimately die, it transfers income tax-free, okay? Now, both whole life and universal life can do that, But index universal life was designed in the first place to maximize your returns and minimize your costs. Now, there's some whole life proponents that use whole life in the banking concept, what Nelson Nash calls the infinite banking, Pamela Yellen calls bank on yourself. I was teaching people how to become their own banker before those two. And so if you're wanting to become your own banker and you do it with whole life, yeah, you can do that. And you borrow money out of your whole life policy to buy your cars or to run your business. And then you pay the loan back. And so you're paying yourself interest. That's nothing magic. You build up cash value. You're using whole life where you pay yourself money by becoming your own banker. But if it works with whole life, it will shine using index universal life if you understand it. Because I have savvy business owners that borrow money out of their index universal life, and they borrow at 2% or 5%, and they keep earning 20, 25%. They keep earning as much as 61.33% or 158% on the millions that still sits in their policy. They borrowed from the insurance company using the cash value as collateral. And whole life doesn't do that, okay? And so if you like the banking concept and you want to become your own banker, I can show you how max-funded IUL is the banking concept on steroids. It blows whole life out of the water. But can you become your own banker with whole life? Yeah. And so sometimes some of these critics of index universal life that say, I can risk your index universal life, well, they're picking up the average index universal life, unfortunately, that's sold in America that is not designed correctly and funded properly to become the best performing for living benefits. And then when I show them, well, show me any whole life policy that accumulates this much money and generates this much income, clear to age 120 without running out of money. And all they can say is, well, that's not my objective when I sell whole life to my clients. It's so that they can become their own banker. That's not the objective. Okay, so what I'm talking about right now is the objective of using cash value life insurance for living benefits, meaning it's going to accumulate the most money at the time in life that you're going to need the money the most, and it's going to generate the most income for the longest. Are you with me? Okay? Whole life will not hold a candle to index universal life. And all they can say is, well, that's not our objective. Okay? Well, that is my objective, so here we go. If that's what your objective is, you need to calculate the internal rate of return, first of all, on a whole life policy. If that's why you bought whole life, calculate the internal rate of return. Now, it's amazing how many financial advisors don't even understand that. I remember one of the nation's top whole life agents when he came through my training, and I said, what's the internal rate of return on this Northwestern Mutual whole life policy? He goes, 8%. I go, no, that's your gross rate of return. That's the dividend rate that you're projecting. I'm talking about the net internal rate of return. He goes, I don't know what that is. They never taught us that. I go, well, there's a reason. I said, okay, it's actually quite simple if you show me a policy that shows just level premiums going into it, because it's a hard calculation if people are paying variable premiums and so forth. So let's keep it simple. I asked this agent, show me, okay, a whole life policy, and it didn't matter what company. It happened to be Northwestern Mutual, which is a good whole life company. I said, show me paying premiums into that whole life policy to age 65, and they projected cash values with your 8% dividend projections, okay? He did, and I said, now here's the cash value. What rate of return would you have to be getting on those premium payments, whatever they were, $1,000, $2,000 a month, whatever? How much interest? Because you can calculate this with an HP calculator, okay? The old 12C calculators would do this. So you simply enter, the number of years or payments. If it's a 35-year-old going to age 65, that's 360 payments of $1,000 or $2,000 a month or whatever. So that's the payments. It's 360 periods because it's, going in there monthly. And then you show the future value, the cash value projected at age 65. And then you solve what is the interest rate you would have to be earning on your money. And when I did that, he was shocked that it wasn't 8%. It was down around 4 point something. He goes, I don't understand it. My supervisors told us to tell people they're getting 8%. I said, that's the gross rate of return. That's not the net internal rate of return. Net internal rate of return is the premiums you paid in. What rate of return would you have to be getting on it to end up with this much money, as if there were no costs or fees? He says, well, there are costs and fees. I said, I know. So you need to know what those costs and fees are eating up out of the 8%. You're earning 8 and you're netting 4.7. That's what your net internal rate of return on your money is. You're only really earning 4.7% cash on cash rate of return on your money. I said, just make sure your clients understand that. But they think they're earning 8% and they're netting 8%. No, there's a bunch of costs in there. That was an amazing awakening, okay? He goes, well, that's not very good. And I said, well, take it out to age 95. So he let the cash values accumulate to age 95 without taking out any money. And we calculated the internal rate of return. It was 5.9. So it took until age 95. If they earned 8% all the way through, that the internal rate of return on the money they put in there was 5.9% interest compounded annually, would have been required to achieve that much money, okay? So let's just simplify this. He had to earn 8 to net, let's give him the benefit, let's round it up 6. He had to earn 8 to net 6. He goes, so what does Index Universal Life do? I said, well, I can get in the money quicker under IRS guidelines. I can get away with less death benefit. So the costs are not going to be 2%. They're going to be within 1%, plus my rate of return is going to be greater under indexing. And so I can earn 9 and net 8, okay? And I don't have to wait till age 95. 30 years into this, at age 65, I can earn 9 and net 8. I can net cash on cash what you're grossing, because you're only netting 5.9. And that 2% differential is huge. He finally got it, okay? But that's what I'm talking about here. So if the objective is living benefits, you have to calculate the internal rate of return. If you don't know how to do that, we can do that for you. Reach out to us. Again, it's complicated if they're putting in different premium amounts, but if you're putting in the same premium and you go out to a given age like age 65. So here's the challenge I've given. If you have a cash value policy primarily for living benefits, I'm going to show you why max funded IUL knocks the socks off of whole life, okay? So the first thing you do is you take either your policy or you simply ask a whole life agent, I want you to fund a whole life policy, hypothetically, with $500,000, as if I want to set aside $500,000 into this policy as fast as the IRS allows, so it's tax-free. And so you do that under what is called the TAMR tax citation. Now, I can put in about 125 grand a year for a 55-year-old, okay? So I can put in 125 grand a year, and that means in 3 years and 1 day, because I put in 125 grand the first day of the first year if I want, 125 grand the first day of the second year. So 1 year and 1 day into an Index Universal Life policy, I'm 50% funded. In 3 years and 1 day, I have my $500,000 into an Index Universal Life policy. The fastest I could do that with a whole life policy would be 6 years and 1 day. It takes me longer. So if it takes you longer to get your money in there, it can't perform as well. You should understand that. But the second thing is under TEFRA and DEFRA. TEFRA and DEFRA dictates the minimum death benefit required so that it's tax-free. With $500,000 on a 55-year-old, I can get by with only about $1 million of life insurance, okay? Whole life is going to require way more than that, so the insurance is going to be more expensive. Let me summarize. A whole life policy for the same amount of money is going to have more insurance, which is more expensive, and it's going to take longer to get the money in there in compliance with IRS rules. So it can't perform as well. So that's why I say, okay, just show me a whole life policy, put it in 500 grand as fast as you can. Take the minimum death benefit. I'm not comparing the same death benefit. I'm comparing the money. I want a return on my money. The death benefit is just coming along for the ride. You got it? See, a lot of whole life agents like to compare the death benefit. No, I didn't do it for death benefit. Okay. Let the cash value after you got your money in there as fast as the IRS allows, let it accumulate to a certain given age, like age 65. If I did it with a 55-year-old, you might want to go out to age 65 or 70 or whatever. You go out there to a given age. 15 years is a good measurement, or age 65 or 70. And you look at the cash value. You take that cash value and then you reverse engineer and you solve what is the interest rate you would have to be earning to have ended up with that much cash value at age 65 based on the premiums you paid in on the schedule you paid them in there. And that's called your internal rate of return, as if the insurance didn't cost anything. It was just coming along for the ride, which is really the objective of max-funded insurance, living benefits. So you do that and you take the maximum income that whole life policy will generate tax-free out to age 100 or age 120 without the policy crashing and burning, lapsing. And all of a sudden, all those guarantees aren't so attractive because, you know, a whole life policy might generate X amount of income, and yet the same $500,000 in an index universal life with the same actual historical performance rate of return, when it's structured correctly, it's much higher income, and it lasts all the way to age 100 or 120. More income, it lasts longer. You earn 9, you net 8, instead of earning 8 and netting 6 and having to wait till age 95 to start taking income. Why do you want to do that? Is this making sense? So you calculate the net internal rate of return. This IRR is probably the biggest secret in the whole life industry because they don't want to show it. They're not even taught it because their ROI, after all the costs and everything like that, usually gobbles up at least 2% of the gross rate of return. And you have to let the money stay in there without accessing anything until you're age 95. Can you use it in the banking concept? Yeah. But if your objective is to have tax-free income and you want to have the highest income and that income lasts longer, max-funded IUL will blow whole life out of the water. Okay? Folks, this is how it works. I often compare cash value insurance, IUL, to a bucket. What I just said is, if I had a 60-year-old male come to me and they wanted to reposition $500,000 as fast as they could, the minimum death benefit under TEFRA and DEFRA is $1 million or $960,000. Whole life that number would be bigger. The spigot on the bucket, the cost of the insurance required to make it tax-free, is going to be a bigger spigot. It's going to be more costly. I can get in maybe 125 grand a year, whereas whole life, it takes me 7 years. With Index Universal Life, I can get it funded in 4 years, okay? And so I can get the money in faster. I can keep the spigot, the cost of the insurance, lower, and that's why it turns into a cash cow. This 500 grand actually becomes part of the death benefit. It actually gets cheaper as you get older because when I have 500 grand in there, I didn't do it for this, but the net amount at risk is the difference between this and this. The insurance company's only charging me an IUL for the difference between my money and the death benefit. That's the remaining 500 grand. But in another 7.5 years, that 500,000 usually doubles to equal the death benefit. Now my cash value has grown to equal or exceed the death benefit. How much is this spigot now? 0. The insurance is free. See, these agents who don't even know this, they go, this Index Universal Life policy is going to crash and burn. It doesn't have any guarantees. Why do I need guarantees to keep this death benefit in force when my money grows to exceed the death benefit within 11 years? It's like, when I say that to whole life agents, they sit there with a deer in the headlight looks. And so, folks, you have to ask yourself that question. So Tamra, we use the metaphor of a 5-story building. If the IRS came to me and said, Doug, you can build a 5-story building. And if you build this building, then if you will just rent out or fill up 1 floor the first year, and the first day of the second year, you can fill up the second floor, third floor, fourth floor, okay? In 4 years, 5 years, you can fill up this building and it'll be tax-free forever after. Man, I would do that. All I'm saying is, whole life, they would only let you rent out about 1/7 of that building every year at the best. It would take 7 years and you would have more costs because the spigot on the bucket, the cost of the insurance with whole life, is greater because you're required to have more death benefit. Okay? So how do you rescue a whole life or an IUL? Is you have to have it audited. We have audited dozens of policies. It must be structured correctly and funded properly to do what I'm talking about. There's a lot of indexed universal life that is not structured this way. And I show people, look, you're paying these premiums for 20 or 30 years into this IUL, and your cash value, it doesn't even exceed the death benefit yet. Well, then what did you do it for? If it's just for death benefit, it's probably okay for death benefit. The policy's in force. It'll stay in force likely, okay? But if you did it for living benefits, what in the world were you doing? You had way more life insurance than you needed to, because if you want your money to grow to the highest amount, you need to have your IUL audited. You need to have your IUL rescued, just like if you took out whole life for living benefits, you need to have that rescued. But if you did it for death benefit, you're probably okay. No need to rescue a death benefit policy. Does that make sense? If you want to learn more about max-funded insurance and how IUL is the dream solution, claim a copy of my book, The Laser Fund. The Laser Fund is what I call a properly structured max-funded IUL. So after what I just said, most IUL in America would not be deemed a laser fund because it does not meet liquidity, safety, rate of return tests like I'm talking about. It's not structured correctly and funded properly for a living benefit. If you want to have a laser fund, then you need to rescue IUL that was done incorrectly, not funded properly, structured, right? Just like whole life. So this isn't some agenda anti-whole life. I'm anti any cash value policy that is not structured correctly and funded properly if your objective is the best net internal rate of return for the highest tax-free income for the longest time period when you retire. If that's your objective, I can make indexed universal life outperform just about anything out there that you can show me. Definitely whole life. So claim a free copy of my book, The Laser Fund. It's flying off of our warehouse shelves. If you buy it on Amazon for $20 to $60, thank you. But I'll give you a copy for free. Simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. I'll cover the rest of that cost and I'll pay for the book. I will fire out a hard copy of this 300-page book to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's options there for your investment. You can even register to attend a free educational webinar that we do on a weekly basis. You can even schedule an appointment with no cost or obligation to talk to an IUL specialist to have your IUL or your whole life policy audited to see if it's performing as good as it could perform if your objective is living benefits. You got it? Okay. Now, this is not about me. This is about you. Hopefully, this gave you some clarity on how you can rescue an underperforming whole life policy or an underperforming index universal life policy.